Good afternoon, everyone. If you could take your seats, please. We're ready to start promptly at 1 o'clock, and we're trying to keep things running on time. I've been instructed to make sure that everyone knows that they need to sign in and out of every session to make sure that they get the credits. And so there's sign-up sheets outside of every room. If you could just make sure that you've signed up, you'll get the credits. The second thing is I've been asked to remind everyone that BNY Mellon is hosting a cocktail party immediately after the final session today, and they're a sponsor. They've been very generous, and it should be a really fun time to meet some new people. I've now been asked to introduce Dan Couvret. He comes to us from Divorce Marketing Group, and Dan is going to speak for a few minutes. He's a sponsor, and they also publish Family Law Magazine. So Dan, welcome.
Thanks very much, Lisa. I actually thought I was talking for 20 minutes, but it's now cut down to 2. So I'm going to give you the Reader's Digest version. Just joking. Divorce Marketing Group has been around for 23 years. We started the company by launching Divorce Magazine. And some of you might know Divorce Magazine. It's no longer in print. It's just online now. But there are 2 divisions of our company. One side of our company helps family lawyers effectively market their practices. And on the table, there's a brochure that says, "Focus on your practice, leave the marketing to us." So you can look at that if you're interested in, if you want to gain an edge in your market, in your marketing, we can certainly help you do that. The other division of our company is with Family Lawyer Magazine, and that is to help business evaluators, forensic accountants, CPAs. We have a website, of course, familylawyermagazine.com. We do podcasts. We do videos relating to Family Lawyer Magazine. So if you're a business evaluator, forensic accountant, CPA, and you want to get a higher profile in your market and be thought of more by the top family lawyers who are here and in your market, we can help you do that. Lastly, there's 2 pieces of information in front of you, and there's a typo in it. Both pieces, it says, "Do you quality to be recommended by Family Lawyer Magazine?" I do know that there is a typo there. But that's just how highly we think of you people. We don't even think of qualify, we think of quality. So you people do quality to be recommended by Family Lawyer Magazine if you tick off all of the boxes that you need to tick off on here. We have a booth around in the other room, and we would gladly talk with you if you're looking for help to market your practice. Thank you very much for your time.
Thank you, Dan, and thank you again for sponsoring. So the next session is on blockchain and cryptocurrency, which I think is a really interesting class of assets. It's been very volatile. And quite frankly, who knows where it's going? We were all looking at our Coinbase accounts last night at dinner, and I can tell you the 2 speakers beat me by far in terms of their Coinbase value. So they do lend some expertise. And what I do know is that even with the uncertain future of Bitcoin and such, that our clients are going to want us to have answers, and the seminar should provide some answers. So my 2 speakers today are Ed Kainen and Richard West. Talk about Ed first because he's a local Nevada attorney. He has a law firm, the Kainen Law Group here, and Ed is a member of the American Academy of Matrimonial Lawyers. He is a member of the International Academy of Matrimonial Lawyers. But more importantly, when I first met Ed, he gave me his card. Coin of the realm here in Las Vegas. Ed has started his own currency, the Kainen Law Group coin, and I will hand some of these out. And it just showed me that Ed is an extremely creative thinker. He has a lot of fun in his practice, and he is a great storyteller. So Ed's going to be speaking to us about what we need to know in terms of cryptocurrency. The second speaker is Richard West. Richard has his own boutique law firm in Orlando, Florida, and Richard has, again, a whole host of credentials, AAML, IAML, leader in the Florida chapters. And Richard is also a Renaissance man. He loves to talk about books, cooking, golf, and both of these men are great storytellers and a wealth of information. So I welcome Ed and Richard to instruct us on cryptocurrency. Thank you. And Ed, I'm going to hand out some of your coins of the realm. I think they're really fun and a great resource for people.
Thank you, Lisa.
Thanks.
Okay. So how many people here actually own cryptocurrency? Okay.
How many have had, I'm sorry, go ahead.
How many have had to come up in a case? How many people have dealt with actually dividing it or valuing it or doing any of okay. All right. So we're going to spend a little time talking about Bitcoin, blockchain, and cryptocurrency. Let's get through this stuff. So we're going to start with the idea of money. We all think of money in terms of a bankroll, or is it really more historic forms of money?
They're interesting for those of you who have read *Sapiens*, and those of you who haven't, you should, but they talk about 4 myths that we as human beings use to be able to communicate with large groups. Once you get over 120 people, anthropologists tell us, communication doesn't work. But these myths do, and the ability to gossip is what separates us, according to the story in *Sapiens*. So the myths include politics, religion, and money, because it's the perception of value, our belief that something has value that makes it valuable.
So we start with the idea, we're going to talk about money. But the question is, we're going to actually start with the idea of the evolution of currency. And sometimes it feels like we're just talking about this for the sake of talking about the history of money. But it actually relates to what we're going to talk about at the back end of the discussion on understanding the attributes of cryptocurrency so we understand how it plays into our exchange of value and transfer these items.
As we're going through this, you might want to give some thought, as we talk about these different things, is cryptocurrency money? Or is it like an equity? Is it an asset, an investable asset? And that's one of the key distinctions that you're going to have to decide at some point in time.
So, in the beginning there was barter, Richard.
Now the problem with barter, was that, well, there was no problem with early barter.
Okay, so we'll go through this.
Give you a moment on that. He traded a fish for a goat or a sheep or something like that. How do what do you say? Well, my goat's bigger than your sheep. I want half the goat back. It wasn't divisible. It wasn't durable. It was hard to carry more than one goat around when you needed to buy something. So here's the currency, the characteristics of currency. It's portable, it's durable, it's divisible into smaller parts, and it's scarce. So how can something that's created out there in cyberspace be scarce? We'll talk about that a little bit.
Okay. So we start with the original, we go beyond barter, and then we started creating things that would identify a value. In other words, something people saw as rare and represented value. And so people would exchange goods for these items of value. So we start with precious metals.
We had early coins. They were easily transported. They had a understanding of value. The denarius, the Roman coin, was used all over the known world at that point in time.
Right. What you were able to do with the coins were you were able to stamp them or imprint them so you could identify a value that would have an equivalent value in other coins.
And the Chinese were the first to invent paper money. Well, does paper money have any intrinsic value? Paper wasn't that rare or expensive to come by, but it had the imprimatur of whoever issued it behind it. And that was the first. Well, let's talk about the basis of value first.
So we start with perceived value. In other words, what's it worth to me? The piece of paper may be worth nothing, where a cow was worth something. So we deal with the idea of what's the intrinsic value of something, what's its perceived value?
Some of you out there, along with me, might remember gold and silver certificates. Remember, you had paper money that said on top of it silver certificate or gold certificate. It was actually redeemable for gold or silver. That's the U.S. has the gold reserves in Fort Knox and the U.S. Treasury. That's history. That's ancient history. There's nothing behind what we call fiat currency other than what the government says it's worth. Now, we're all fortunate enough to live in America. Stable economy, stable government, stable history, at least for the time being. And most of the world does not feel that way. And so the growth of cryptocurrencies has been much more dynamic and pervasive in other countries.
So a good example is you have a $20 bill. It's probably reasonably certain that 2 weeks ago, 2 years ago, or 2 weeks or 2 years from now, you can probably exchange that $20 bill for something that is approximately $20 worth of goods or services. But if you're in Venezuela right now and you have a document that says whatever the equivalent value is that going to be worth the same thing tomorrow or next week or the week after? So because we have a stable government compared to other governments in the world, fiat currency is something that works.
In the past, Germany, just before World War II or after World War I, between the two wars, you would need a wheelbarrow to carry enough money to buy a loaf of bread. The Deutschmark had been devalued so horribly. I was in Zimbabwe some years ago, and they literally told us if you're going to have cocktails after your round of golf, better that you buy them now because they will be more expensive in 4 hours when you finish up. That's runaway inflation. We don't have to deal with that yet.
So we get into then there's vehicles that you can actually use as currency or as a replacement. You get into credit cards, and now there's this.
I took that picture in Prague. It was the first Bitcoin ATM I had ever seen. If you get on your phones and Google Bitcoin ATMs around me, at least when I did it this morning, I found 4 within a mile of where we are right now. How many have ever seen a Bitcoin ATM? A couple. Mm-hmm. They're there. We just don't notice them yet, but they're there.
Okay, so the future is here. We get into Bitcoin, the concept of cryptocurrency, and we start with the idea that Bitcoin itself is born. And it starts with a guy named Satoshi Nakamoto. Richard?
In 2008, now Satoshi Nakamoto, nobody knows who he is, or even if he's just one person or a group of people. It may be a pseudonym. But in any event, in 2008, he published a white paper, which is included in your materials. It's worth reading. It's dry, but it's not long, called Bitcoin, a peer-to-peer electronic cash system. And what it did was it solved the double spend problem. When we're using money, currency, or poker chips, or anything else, it has a physical embodiment. And so if I have a coin and I give it to David, David now has the coin. There's no doubt that that's the case. When we have high-speed photocopiers, we can copy paper bills. That's a double spend problem. It's called counterfeiting. That's no good. But when you're dealing with a token that's in cyberspace, how do you know, how do you verify that you own that token and that you have the right to transfer that token to somebody else? That's the double spend problem. The Satoshi Nakamoto solved that.
At its very simplest form, the double spend problem is no different than kiting checks. So in other words, writing a check, but by the time it takes to get through the system, the money's gone. And the idea was Satoshi Nakamoto, through Bitcoin, solves the double spend problem.
Now, Bitcoin, most people, when they say cryptocurrency, they think of Bitcoin, but it's just one of, I think, what, 1,700 or so right now?
It's growing all the time. I think it says 1,600 when we did this in August of 2018, and it continues to grow.
So, remember we talked about the characteristics of money?
This is where we're looping back. In other words, talking about the idea of something tangible and those kind of things. So let's look at the compare. Bitcoin, in other words, is this electronic currency, this idea, going to meet the definition of currency?
All right. It's easily transported. I mean, you don't even have to carry it. It's not heavy. It doesn't fill up your wallet, make a lump in the back of your pants. It's durable. You don't handle it, so it doesn't wear out. It's there forever. It's divisible. This is interesting fact about Bitcoin, not the platform, but the token itself. By the nature of what Satoshi Nakamoto designed, you can only have a maximum of 21 million Bitcoins. Now there are about 17 million in circulation. We'll talk about mining and how they come into being in a little bit. But they are divisible into smaller units called Satoshis. And they're almost infinitely divisible.
So you can go in, even though a Bitcoin was trading at one point at $19,000, you can go in and theoretically buy $5 worth of Bitcoin, which is a tiny percentage of one Bitcoin.
And again, scarcity, there's only 21 million that will ever be in existence.
So it's probably also worth talking about the small b and the big B.
Right.
So the big B, when you talk about Bitcoin, is the concept or the platform. The small b is an actual Bitcoin, in other words, the ownership of that specific currency. So sometimes you'll see them used interchangeably, but there's really a difference. So a lot of times, Bitcoin is used generically for all cryptocurrency.
We should have mentioned too, as we started, that if you have questions, raise your hand. Somebody will have a microphone to hand you because this is being recorded. We may very well say, hey, we're going to get to that in just a few minutes. Hold on, we'll answer it. But if not, we'll answer it now. So don't be shy.
All right. So these guys are some of my favorite guys, and they're going to teach us really in about 2 minutes everything you need to know about Bitcoin.
Oh, Stuart, good. I was wondering, will you be accepting Bitcoin?
Well, I don't know what that is, but it's got coin in it, and my cash register doesn't. So, yeah.
Wait, what's Bitcoin?
It's a new online currency that's been developed. It's just like actual money, except you can't see it, hold it, or spend it on anything.
Sounds like the kind of money I'm familiar with.
If it's not tangible, how do you know it's not just going to vanish tomorrow?
Really? You're dating Penny and you're going to poke at something that could vanish tomorrow?
I'm nice in Bitcoin. I just came into a little extra money when my dad raised my allowance.
You don't have to buy Bitcoin. You can mine it.
Mine it? Like mining gold?
Yeah, sort of. There's a limited amount, and we find it not by tunneling into the earth, but by using a computer to solve complex mathematical problems.
So let me get this straight. We have to write an elaborate program in order to find a fake coin that we can't spend on anything?
Yes.
That sounds fun.
Yeah, I'm in.
Staying up late, writing code, and sounds like a party.
Hey, Stuart, you want to mine some Bitcoin with us? We'll write the program, you bring the snacks?
Too rich for my blood.
All right, so just the four of us.
Before we begin, this may have some unprecedented tax implications. In fact, we should start early because we're going to be on the phone with the IRS for hours. Did anybody else just get goosebumps?
Great, so just the three of us.
All right.
So first of all, you can spend it. 160 plus major companies now accept it. Dell, Microsoft, luxury yacht brokers are accepting it. Car dealerships are accepting it. It is freely spendable. There's no question about that. Mining, we're going to cover briefly, has become a bit of a different thing now that it has value. Back to history for just a moment. 2008, the white paper was published. The Genesis block, the very first block in the Bitcoin blockchain, was 2009. Satoshi Nakamoto, again, had a message embedded in it. Those Star Trek fans remember Genesis effect? And this is the Genesis block. It's important because it starts the validity of the entire process. The first actual commercial transaction in Bitcoin was in 2010 when a gentleman in Jacksonville, whose name I can't pronounce, bought 2 pizzas worth about $25 for 10,000 Bitcoins. And you can go look up that transaction if you want to see it. It's there. And we're going to talk about this a little later.
Now think about that. 10,000 Bitcoins that eventually became worth, each one of those Bitcoins eventually became, at their peak, a little over $19,000 each.
Some of the other landmarks, it rose above $1,000 in 2014, and I think it was 2017 when a single Bitcoin surpassed the price of an ounce of gold. So value has been increasing. It's dropped off greatly. Ed will tell you how to make 600 and some odd dollars in Bitcoin.
I have a Bitcoin wallet, and I have $683 worth of Bitcoin. Now I can tell you how to get I can tell you how I got $683 worth of Bitcoin. I started with 1,500. So Richard had a different experience.
I started looking at this maybe 4 years ago or so.
But in all fairness, he got into the Bitcoin market only 3 months before I did.
Oh, no.
No, yeah. You were in November, I was February. Something like that.
No.
All right.
I was riding in the back seat of a friend's car, and somebody mentioned Bitcoin, or the radio said something, and I pulled out my phone, and I downloaded a Bitcoin application, and I had to fund it. and for some reason it wouldn't let me use my American Express card. All I other had with me was my debit card, and all it would let me use was $200. So I funded it initially with $200, and I think today my Bitcoin wallet has about, I don't know, $700 or $800. We just looked at it a few minutes ago. It was up as high as $2,400, $2,500 at some point. Don't invest in Bitcoin.
No.
It's not.
You're not
It's
gonna
not
make your
what you want to
fortune
do.
there.
And that's going to be an issue we talk about in a little bit in the divorce context.
All right. So we all are familiar with IPOs. With Bitcoin, you have initial coin offerings, ICOs. And so when you go back to the slide we had before about there being 1,600 or 1,800 cryptocurrencies out there, each one of them effectively begins with an ICO. They try and drive interest. They're going to be the next big one. There's still only a few really big ones that you see. You're going to see Bitcoin, you're going to see Ethereum, you're going to see Litecoin, Monero, Ripple.
Those Monero and Ripple, they're coming along because we're going to tell you in a little bit, Bitcoins are hard to hide, okay? They're not anonymous, and they're there forever. And when you know how to find it, which we'll tell you in a little bit, they're there. Monero and Ripple are a little different. We're not sure what to do with those yet.
All right. And then it's also just to think about it conceptually when we deal with the currency issue. Again, if the SEC can regulate ICOs, question is, are they money or are they equities? So let's talk about what's all the hype. Anybody know what these three folks have in common? Undisclosed paid endorsements, unlawful touting, pump and dump. And this is what they each came away with. So what you see in a lot of this is that a lot of people who have a big following, for example, you're using your Twitter following to say, you know what, I'm going to invest in this upcoming ICO, I'm going to buy this. All of a sudden it drives up the value, they dump what they have, and you end up with the SEC has stepped in and it's actually started imposing penalties.
All right, so really what's more important than understanding Bitcoin at this point, we believe, for those of us in this room, is understanding what blockchain technology is. Blockchain technology is what Satoshi Nakamoto relied upon in order to solve the double spend problem. If you watch TV, you begin hearing ads from computer companies where they talk about blockchain, AI, artificial intelligence, and IoT, Internet of Things. These are the new tech areas that are being explored. So we're going to talk a little bit about blockchain for you and explain this.
In other words, Bitcoin and cryptocurrency operates within a blockchain format. And blockchain is really the future of what we're going to see as things develop. So we start with the idea, Richard, what's a block?
Well, let me back up just a little bit. Blockchain and cryptocurrencies have four components. Hardware, you need the computers to operate them, or tablets or your handhelds. Software that lets you know what you're dealing with. Cryptography, that's where cryptocurrency comes from, is there's very complicated algorithms. The ones that's used in Bitcoin, by the way, was developed by the NSA. It's called SHA-256, Secure Hash Algorithm, and we're going to talk about hashing. But what happens, and then the final component, interestingly enough that we're in Vegas, is game theory. And game theory plays a real role in this because what the miners do is they prove the validity through the algorithm with their high-powered computers. And when a block is completed, and right now it takes about 10 minutes for a high-powered computer to complete a block, it's then put out on the blockchain, which is a distributed ledger. We're going to come, and each block contains data. And each block is linked to the block before it. So it's an immutable ledger. It's one of the drawbacks of the whole blockchain protocol is once something is there, it cannot be changed. You cannot go back and correct errors. You can't reverse transactions. It's immutable. And so...
And it doesn't exist just in one place.
Well, that's what decentralization... You can tell us about decentralization?
Right. The beauty of the way blockchain is employed is it's decentralized, meaning it's not just in one place so it's subject to being hacked. There's no single authority that controls it. no single data repository, no single government, and no geographical boundaries. So when someone enters something on the block, so if we look at going back to the cryptocurrency, a transaction, in other words, when I purchased, 0.25% of one coin, it went into the ledger and it was specific, and it went onto the ledger, and it's always going to be on that ledger that shows that that purchase happened. And anything that goes into the blockchain ledger will always be there. It's shot out across multiple repositories, and it stays there forever. And so there's no way to hack just one computer, as you can't go to just one place and be able to try and disturb that.
The term that you'll see when you're reading about this is disintermediation. There's no intermediary that's responsible. You know, when we write a check, if I wrote Ed a check, it would go through a bank. That bank is the intermediary. Governments stand behind their money. What this is, you know, the figure on the left is what's centralized is. Everything comes off of one central node. That's like the ACH system in our Federal Reserve. Decentralized is when there's more than one node, but you see a lot of the points are not connected to the others. In the distributed network, everything's connected to everything else. So if we have hundreds of thousands of computers that have exactly the same data, you don't need trust. You don't have to trust the financial institution. You don't have to trust the government because you have millions of people who have the same information. You can't cheat. Everybody has the same information at the same time. And that's what a distributed ledger is. That's what makes it work.
Okay. All right, we can skip through this.
So here's what happens. Somebody has some Bitcoin. I buy something and I transfer my Bitcoin to seller A. They wait for confirmation. The confirmation comes from the miners who hash, and we'll show you a picture of a hash here in a minute. I know this is all like, what are you talking about? It's a new language. In the written materials we gave you, we've given you a glossary of terms. We're just scratching the surface for you, but we're giving you key concepts. So this hash is what proves the transaction. The first hash that comes up, the miner gets rewarded right now in 12.5 Bitcoins. And that's where game theory comes in. They want to do it faster and better than anybody else, so they get the 12.5 Bitcoins. Once that is confirmed, then usually the rule is you want 6 further confirmations. So 6 other miners are going to confirm the validity of that. Now it's a done deal. It's part of the permanent block.
Okay, so let's get into what is, actually there was a question, apparently this is being webcast, and so there's a question from the webcast, it's what's the difference between Ethereum and Bitcoin? And so that gets into the small b, capital B. When we use Bitcoin with a capital B, that's again the entire system of cryptocurrency. Ethereum is one type of cryptocurrency, much like Monero, Ripple, and Bitcoin with a small b.
The other, Ethereum is built on a system that they use what's called smart contracts. We don't have time to deal with that here today, but I think in the future it's going to have impact on the way we practice marital and family law because these smart contracts are instantly verifiable and enforceable. I think that's a ways out, but that is my belief. A Russian developed Ethereum, and it's a little different system than Bitcoin.
All right, so the guys from Big Bang Theory were excited about this idea of mining, solving problems and getting rewarded. So mining went from this to this, and now this is what mining from Bitcoin theoretically looks like.
Has anybody ever seen a Bitcoin mining or a crypto mining operation and gone into it? It's an amazing thing, and when the values went up, you began to see farms like this. You can only imagine how many hundreds of thousands of dollars are tied up in that. Do you have the picture of the garage?
Yeah,
the garage mining?
Hold on a second. Hold on, I thought I would do. Let me see if it pops in here. Okay, hold on a second.
There you go.
Okay.
This is more like what you saw in the early days of Bitcoin mining. And the problem was at that point that it takes a tremendous amount of energy. The computers operate, they throw off heat, you have to cool them. It was not unusual for early miners to spend more on their electric bill than they were making in the value of the Bitcoins that they were mining.
And one of the things that happened is a lot of these mining war rooms are up in the Seattle area and everything because the cost of energy is so low. So it wasn't computer power, but literally air conditioning as to what was needed to keep these computers from overheating. So let me back up here. So we solve the encryption, we get the Bitcoin, we've got the farm, and where did I go? There we go. Why is that not? Oh, there we go, got it. All right, so cryptocurrency transactions actually happen through online exchanges. Both Richard and I use Coinbase. It's simply an app on your phone. It's also, you can go to it online as well. And what it does is it keeps track of the Bitcoin that either one of us own. We can go at any time, and it's updated every, what, 2 minutes or so? And the value changes.
And if you look at different cryptocurrency exchanges around the world, at any given moment, the values may be slightly different, adding to the complications of this. Attached to your written materials is a case, United States versus Coinbase Incorporated. The US government a few years ago snapped onto the fact that there was a huge economy that was not being taxed, and they served a subpoena on Coinbase, which is located in California, and they opposed it and they ultimately lost. I include that because should you need to serve a subpoena on Coinbase or another crypto exchange, you'll have some idea of at a minimum what you should include in there.
So some of the issues you get into in terms of advantages and disadvantages, there are privacy issues that are significant. In other words, when you operate, and we'll get into some of this in terms of wallets and cold storage and hot storage and things like that, you deal with volatility whenever you've got to have something that's monitoring value all the time because the currency itself is incredibly volatile. And then there are tax issues, which we'll probably touch on a little bit later.
Right.
So, all right. So let's talk about e-wallets and cold storage. When we talk about Coinbase, for example, that's probably as close as you're going to get to what's called an e-wallet. In other words, it's an online place where you store your currency, it's password protected, and you're able to access your Bitcoin or its value, things like that. And that's what we call, some people call it a hot wallet or a wallet, an e-wallet. And then there's something else called cold storage. Cold storage is entirely different. Cold storage is using an identification number, and it's taking it offline, and you can hide that identification number. You can bury it in the backyard in a cigar box, and nobody else can get it unless they get access to your wallet or your currency, unless they have those particular code numbers. The problem there is it's subject to being lost.
And you're dead
right,
at that point.
Exactly.
Yeah.
So public addresses.
But before you do that, just flip back a second,
Okay.
Ed. You see on the left what that looks like is a digitized thumb drive? That's cold storage. You could store hundreds of thousands, millions of dollars worth of Bitcoin on that little device, and even if you have subpoenaed the person's computer, you are not going to find their cryptocurrencies because they're stored on that particular device. So just mentioning that at this time. All right. A public address, and you see at the bottom an example of a public address, and what you need to take from this particular slide is it always begins with 1. So one of the questions you're going to be asking when you do your discovery is, what public address does the person use? And they can use more than one. The public address is what's used to receive Bitcoins or to receive the value of what you get. It's public because you don't care, you don't mind putting it out there.
Okay, so private address.
This is the key. This is the key to everything. And this is what you must get if you believe there is Bitcoins out there that have not been accounted for. A private address always begins with the number 5. And the specific question is, what is your private address for any cryptocurrencies you hold? I imagine you will get an objection.
Well, yeah,
to
because
that.
if I give somebody my private address, the other party, the lawyer, everybody who's in the lawyer's office, anybody who sees the pleading or the letter or the document, then has access to that cryptocurrency. So
This is the key. This is the most important thing to take away from this lecture. If you're trying to track down cryptocurrencies, you must have the private key to do what you have to do.
So let's talk about Quadriga CX, although we have another one we can talk about as of
Just happened
yesterday.
yesterday.
On February 1, 2019, it was reported that Quadriga CX struggled in recovering funds stored in a crypto wallet as well as a cash stored by third parties. Their statement was, for the past weeks, we've worked extensively to address our liquidity issues, which included attempting to locate and secure very significant cryptocurrency reserves held in cold wallets. And they are required to satisfy customer cryptocurrency balances on deposit, as well as sourcing a financial institution to accept the bank drafts that are to be transferred to us. Unfortunately, these efforts have not been successful.
But what
the
happened
company
there?
said.
The CEO died and they couldn't find the...
Yeah, he sort of died, and he had that cold storage. He had that number effectively buried in a cigar box in the backyard or on a jump drive somewhere, and no one knows where it was. And the problem is he was effectively a broker. Quadriga CX was one of those companies that held people's cryptocurrency. And so everybody who had a Quadriga CX account lost access to their money. So this is what's missing. Oops. If you caught the news yesterday, it was Binance got hacked. Now, somebody actually, it's effectively like hacking Coinbase or something like that. In other words, it was something that was done in the process of transactions where they got access to something. And so, again, your cold storage would have protected it. The question is how much protection and how much do you isolate or risk losing currency in that respect?
So moving into the divorce realm a little bit, there's some common misconceptions about Bitcoin or cryptocurrencies. One is that it's anonymous. It is not anonymous. In fact, it's probably the most well traceable of all assets, with the exception of real estate, which, by the way, many countries, Eastern Bloc countries, now used to be Eastern Bloc countries, have gone away from title companies and are now using blockchain technology to record their land records. And I think we'll see that as well, because it is immutable. So every transaction, every single transaction that has ever occurred using Bitcoin, you can find, and they're free. You can download them. One is btc.com. That will let you analyze Bitcoin transactions if you have even the public address. You don't need the private address to trace the transactions that somebody may have entered into. And so that's one of the first misconceptions, that it's anonymous. The other is that it's used to launder money. You probably heard about the Silk Road thing some years ago. The guy was dealing drugs online and using Bitcoins. Very little of that actually goes on. Blockchain is just a better database. It's not just a database, because database records can be changed. Those of you who work with databases know that. You make a mistake, you go correct it. Blockchain is immutable. So once it's there forever, which to us is a boon if we're trying to find assets that somebody's trying to hide. The other, we mentioned, blockchain is Bitcoin. No, it's the platform upon which Bitcoin operates. And the other, I think we mentioned as well, that you need to buy a full Bitcoin. I would encourage anybody who wants to know more about it, throw a couple $100 into a coin wallet and play with it. Buy stuff online with it, send it to your friends, get them to send it back to you. You'll see how the transactions work. It's unusual at first, but it's no more difficult than Venmo or PayPal or anything like that. It just works in a different fashion.
But what it does is it gives you the ability to know what our clients are dealing with and things like that, and understanding just fundamentally, once you start playing with it, it makes a lot more sense. The other thing that Richard touched on is really kind of important to get, is that the blockchain technology is going to be probably the next place you're going to see blockchain truly exploding is in real estate transaction records, because you have a fixed place and you want something that will track every transaction related to that parcel of real property. And so it's already starting to happen in Eastern Bloc countries, and I think it's not far-fetched to say that we're going to see that here before too long. And a lot of title companies are not going to like that, because it's going to take away a lot of what they do.
Walmart is using blockchain technology to manage supply chains in food that they're buying from China, for example, tracking food shipments. The healthcare industry is now using blockchain technology to store medical records that shouldn't be changed.
They're using it in livestock. In other words, remember years ago you had this mad cow scare. What they're doing is they're identifying individual animals, individual livestock in order to be able to trace back where, if there's a problem with, a particular parcel of food or a particular meat or something like that, where it originated from. So there are lots of uses that are going to become, and as we said, the bigger issue is going to be blockchain technology going forward, and the Bitcoin and cryptocurrency is going to be more a symptom of that. But for our purposes in divorce, that's where people tend to want to hide money. So we have fundamental issues in divorce. You have finding and disclosing property, whether to value it or divide it, whether to treat it as dissipation or waste, and how to go about that. So let's talk about some of the malpractice pitfalls.
Well, I think the first one is failure to know a little something about it. So you guys have probably jumped through that hurdle. You now know a very little something about it because we don't know a whole lot more.
So it's a good thing to learn caution from the misfortunes of others. Think about the things that have been missed and take the lesson from that.
The next thing, and you're probably okay here even under your current set of discovery requests, but you should specifically be asking about cryptocurrencies. Have you ever owned any form of cryptocurrency? If so, what kind? What kind of e-wallet did you use? When did you buy it? But bottom line is, if you think of it as money, as it is, it had to come from somewhere. So unless somebody is mining it, and you're going to know that if your spouse has been mining it, unless they've got some operation you know nothing about, the genesis of the Bitcoin had to be purchased somewhere. So it came out of a bank account. It came off a credit card. You should be able to find those transactions in your normal review of your financial records.
But what you can do immediately to sort of keep yourself ahead of the curve, stay out of trouble, is do things like look at a Bitcoin account or a Coinbase account or any of those, no different than any other investment account or anything else. And so add a line to your discovery requests, add an interrogatory to your standard set of ROGs, and be able to ask specifically about it. So instead of saying bank, brokerage, etc., add cryptocurrency or any of those kind of accounts to that. And by the way, in the materials we've attached a sample discovery request, sample interrogatory that can be added to your standard requests.
And we thank our Academy President, Peter Walzer, and his partner, Chris Melcher, for those materials.
All right, so the key for discovery is, you're going to get in trouble by not making an appropriate inquiry. In other words, not asking about it, finding out later that it's missing. Some states, you get into, you're barred. If it didn't come up in the divorce, you're barred forever. The person who committed the fraud got away with it. Or there's some statute of limitations, and so you've got to make the appropriate inquiry. You've got to propound formal discovery requests. Again, there are samples in the white paper. Review bank statements. So in other words, just like you would look for waste or dissipation or anything like that, look for unusual transactions in the discovery that you would otherwise get. As Richard pointed out, it's going to come out of an account generally. And by the same token, if you've got somebody who's taking $200 out of their paycheck every 2 weeks and taking it in cash and doing stuff like that, I mean, just like we're not going to find that money that would be in a shoebox in the backyard, we're not going to find the Bitcoin that's anonymously purchased for cash at a storefront in New York City. But most times, most people who are going to move a large sum of money, in other words, something worth chasing down, into Bitcoin, there's going to be a paper trail that's no different from a lot of the other paper trails we tend to see from people who are trying to dissipate or hide assets.
Now the difference where that is not going to be correct is somebody who got into Bitcoin very early on when it had very little value. If you bought 10,000 Bitcoins for $25 back in 2009, you've got millions and millions of dollars now. The interesting thing though, and I haven't had that many cases where it's come up, but in each and every one, it's generally the husband who had some Bitcoin, and it's generally the wife who said, oh yeah, he drove me nuts talking about that, how we were going to get rich off of it. And that's kind of the discussion. People talk about it, they were interested in it, so it's generally not a secret. Now, how much is there and what it's worth, that's a different issue.
So if you've got that issue come up, some of the suggestions to think about are, number one, making sure you're asking appropriate questions in your depositions, your interrogatories, and your discovery to make sure that even if you don't locate something, you've built a case for fraud or dissipation. You've got to consider, in your negotiated settlement, building in a waiver of a limitations period for going back and being able to find something. In other words, if 15 minutes after the divorce, all of a sudden, these parties who divided $50,000 in assets, the husband's buying a Mercedes and he's buying a beach house and everything else, you've got to be able to build in your case for fraud and dissipation. So when we get into, so if we find that someone has purchased or hidden Bitcoin, we get into the question of how do we value it? In other words, it's really, really volatile. So anybody have an idea of how you come up with how we value this? Richard, how would you value it?
You know, you look at several different exchanges, but what it's worth today can be dramatically different tomorrow. So at least if I was going to value it and my decision with my client was to take it as opposed to dividing it in kind, I would take it at that daily value, and I would probably tell them, sell it. Turn it to cash right away, and you know what you're getting.
If you convert it, you know immediately what it's worth at a particular point in time, and everything beyond that is a gamble because of the volatility. Anytime you do this, make sure you do CYA. In other words, it's almost never a good idea. I mean, the question is, do you take the Bitcoin? Do you take half of the Bitcoin? Do you take value in exchange for the Bitcoin? Whatever you do, think about a CYA letter to explain to the client the risk because of the high volatility. Whatever can go wrong will go wrong, and who are they going to be looking at?
What do you do with a situation where somebody got caught up in the mania a year and a half ago and bought a huge amount of Bitcoin at $19,000 a coin, and it's now worth, what, 6? I think recently
something like that.
It's around 6. Huge losses. Is that dissipation and waste? Do you have a claim?
Yeah. In most cases, the question is going to be evaluated like any other dissipation claim. In other words, was there good faith in what was going on? In other words, was somebody sharing information? You know, it's a very different case if all of a sudden $100,000 is discovered missing to buy 5 Bitcoins and nobody was consulted. Whereas if you have the husband who was saying, "Oh my God, this is great! It's going off, it's going through the roof. I'm going to buy it. I'm trying to like make money for us so we can buy that beach house we've always wanted." There may be a question of poor judgment, but there isn't a question of fraud in those kind of situations. There's not what would normally be the standard for dissipation or waste, where someone is doing something nefarious.
Within the last year, there was a case, it was either out of Nevada or California, I can't remember which one, where the court rewarded the wife in that case, saying that her husband had dissipated an asset because he had told her he was going to invest in something. I think it might have been Bitcoin, it might have been options. And she was really against the idea. He finally talked her into investing $100,000, and instead he invested $500,000, and it all went to garbage. And the court said, no, that's dissipation or waste, and rewarded her.
Right, but to circle back, again, even though you're dealing with a different sort of currency, the evaluation of the issue is no different than if he had bought some penny stock or anything else. In other words, was it done openly? Was it done with good intention? Was it done after consultation? All of the kind of questions you would ask in any other dissipation or waste claim. So let's talk about tumbling, and how about the overlap between tumbling and Monero or any of those?
Well, tumbling and Monero are a little different. I'm
Right.
not sure I can understand the difference. Remember I told you earlier you got this immutable blockchain that traces all these transactions. Well, there's because cryptos are fungible, like cash, these tumbling platforms mix up the transactions so that it does become untraceable. You're not going to find this in your regular daily user kind of guy. Somebody is set out to make sure that people can't see what they're doing, whatever it is they're trying to do. Check some of those sites, Bitcoin
Right.
Laundry, BitMix, BitLaundry, they're out there. You'll be amazed, actually, if you start looking on the internet, how much is out there. If you want to learn more than what we're going to cover today, I'll mention this to you now. It's not in the materials, so you might want to write it down. There's a company called Udemy, U-D-E-M-Y, that does online education. They're great for learning how to use various pieces of software. But they've got a huge content on Bitcoin, cryptocurrencies, and blockchain technology. They're easy, they're inexpensive. If you don't want to spend a few dollars, YouTube is full of stuff. You can find immense amounts of information on there, but you will be amazed at how much content is out there. Cryptocurrencies are alive and well. There's people who believe that they are our future, and you're going to see more of it. Monero doesn't need a tumbling service. By its own internal architecture, it's designed to hide those transactions, and I haven't studied up enough to tell you how that actually works.
So the bottom line is that like any other assets that's there that is subject to being hidden, there's an appetite for people who are willing to take advantage of being able to hide it. So the only message really from this part of the presentation is if in your web searches you see, or if your online examination or anything like that, you trip across searches or a computer that spends some time on BitLaundry, BitMix, Bitcoin Laundry, any of those, that's probably a pretty good red flag that something's amiss. And so that's when you want to start looking further. And if someone's gone to this trouble, at that point it may mean taking this to a much higher level. And there are people out there in the country who are real experts in being able to go beyond the kind of tracing or the kind of discovery we're talking about. What was the?
I can't remember her name. She's in Texas. And
Yeah.
She's super knowledgeable.
But there are people out there who can do this. So if you truly have a case where your normal due diligence trips across the information that says, wait a minute, I need to go further and I need to go deeper, then that's when you need to be able to consult somebody who really is truly an expert in this. Our goal is to give you enough to be able to recognize the red flags. So, and in a nutshell, tumbling is no different than sort of a mutual fund, if you will. And there's a lot of money going in there. It loses its identity. And the goal is to be able to make it less traceable through the blockchain.
To use Lisa's analogy from last night,
I was debating about that.
The different colored M&Ms.
Right.
So I think if you mix all the different colored M&Ms together, you can still pick out the green ones and the blue ones and the yellow ones. But I think the tumbler changes colors.
Right. So Lisa's example, we'll give Lisa credit for it. Was you took a beautiful bottle of tap water, a beautiful bottle of Fuji, water, and then you took a bottle of toilet water and you pour them both in together. Now the question is it forever mixed? And the answer is yes in that case, and that's what tumbling really tries to do. So,
all right, let's talk about some tax issues.
Right. Sheldon got excited about the tax issues. So we start with some basic questions. Is it a currency or is it commodity? And there's a difference because in some contexts, like the SEC is looking at it, so it's certainly a commodity. The issue may be, what are the tax impacts when do you have a tax impact related to the cryptocurrency?
Now remember, you don't have to sell your Bitcoins and turn them to US dollars or Japanese yen or euros in order to use them. You can use them to buy computers or groceries.
Or a pizza.
Or pizza.
So,
and so what they tell us is that every time there's a transaction, it triggers a tax event.
Right. So here's the deal. These folks who bought Bitcoins and held them for a couple of weeks and decided to use a little bit to buy a pizza. Well, there'd been some change in the value. That change in the value happened within a short period of time. They then liquidated their Bitcoin. Is there a better definition of a taxable event and a taxable obligation that comes from that?
So again, in the malpractice arena, if let's suppose you found Bitcoin. Let's use the husband. He's been using Bitcoin for several years, but he's never reported any of it on his tax return. They file joint tax returns. Is your client now liable for that tax hit if and when it comes? And if there is that concern, what are you going to do to protect her from that?
So what you've got to do is you've got to evaluate the risk. What kind of numbers are we talking about? What kind of spend what was the spend rate? How much did you have at one point in time? How much was liquidated? When was it liquidated? Those sort of things. The good part is, if it's done above board, it can usually be traced, each of those transactions, to see what was acquired, when it went out, and where it went. And so it's actually, finding the information isn't crazy if you know what you're doing. But again, it's recognizing the red flags so you know there's a potential issue there.
Right. We mentioned buying goods or services, but like any other commodity or security, It's not unusual for people to engage in trading. So, you think Bitcoin is going to go down, and the next day you trade it for Ethereum or Litecoin or one of the other cryptocurrencies. And this can go on and on and on. All of those gains are realizable. When are they realizable? We're not sure. Is it when the trade occurred, or is it when it's monetized?
All right. So when we get into cryptocurrencies, what's the impact in divorce? The reality is it's just another asset in most cases. The real question is being able to identify the time and doing the digging to be able to find out if you have this asset there. But when you find it, it's really not any more difficult, and it shouldn't intimidate you any more than any other asset that exists in a divorce. And that's really the takeaway from this, is there's a lot of crazy stuff, and the deeper you dig, the more you can learn, the more you can trip across, but it's really no different than any other asset that we trip across.
Let me ask this question to the group by show of hands. If you came across $100,000 worth of Bitcoin in a divorce case, and let's suppose you had, let's call it the wife, who didn't know anything about the Bitcoin, is not financially sophisticated, what are you going to tell her to do? Who, by show of hands, who's going to tell her to take half the Bitcoins and ride it out and see what happens? Who's going to tell her, take the money right now at the current value? And the rest of you are just asleep. I get it.
Well, I mean, honestly, there's really some truth in that, Joy, because the idea is that we're not experts in this area. None of us are. And so, but we're recognizing red flags. And when the situation comes up, the lesson there is to reach out to somebody who can actually give good, strong, competent advice. Now, I think Richard's instinct is right. In other words, if we trip across this, is it a dependable asset that you can ride out? No. So if you're going to be conservative and smart, the safe recommendation is to be able to take it in, liquidate it. Which, by the way, is the same question. Wasn't it Florida that had the question? It dealt with the question of whether or not cryptocurrency could be used to pay a lawyer.
Right.
And I think the decision, if I remember from one of the DCAs, was that it was no problem accepting it for a retainer as long as you converted it to cash right away, because otherwise the money in trust wasn't really secured the way that anything else would be. And so the same lesson is there, when we think about that. In other words, it's insecure enough, it's volatile enough that you can't depend on it being there. So the easiest thing to do is, if we know what it's worth at this moment in time, let's convert it to cash so it's stable.
If the family took a bath in Bitcoin, lost tens of thousands of dollars, by show of hands, who thinks you have a dissipation or waste claim on that basis? And who thinks you do not?
Who thinks you need more information?
Okay, let's add the more information we talked about earlier. The family had a discussion. Mom says, no way, are you crazy? Don't do it. He does it anyway. Is that dissipation or waste?
Probably. Yeah.
What if she said, don't do it, you're crazy, he does it anyway, and it triples in value?
Bonus. All right. All right. So, what is it? Now, we've scratched the surface in a lot of different areas. The goal was to give you guys a decent vocabulary, sort of a framework to be able to look at this. What is it we can answer? What questions could we answer for you? Yeah.
Yeah, one second. Let them bring the microphone over to you.
Yeah, they're going to bring the mic over to you.
You had said earlier that if upon deposition you asked for their address and they opposed that because now they could go in and attack it or get the money, the Bitcoins. What do? How do you resolve that?
My guess is there's probably, in other words, if we're dealing with enough to be worried about, we're probably maybe appointing a third-party master or something like that to be able to marshal or secure certain assets. It's kind of like, I had a case years ago. Vegas is an interesting place to practice, and I had a case, a professional gambler years ago, and we knew that a significant portion, a significant chunk of money, in this case, it was a little over 7 figures, was in poker chips. Now, for those of you who want a more effective way to hide money that's untraceable, talk to me about poker chips, okay? They really are. I mean, unless your casino goes out of business, which happens once in a while, depends on who's running it, but when your casino goes out of business, that's the only time those poker chips really aren't good. And otherwise, you can keep liquidity and move them around and trade them and everything else. So in this case, what we did is we knew we were going, by the way, some of the casinos have private vaults for players. And so there's basically a safety deposit box that you use to keep money before you go into a high stakes room. And so we knew that this particular player had 6-figure or 7-figure money in his locker. We got effectively a warrant from our judge. In other words, we went to the casino. He was at the table playing, so we had someone go to the table and see what he had on the table. And then we drilled the box. We were able to inventory the box under the supervision of security at Bellagio at the time. And then we had an order that instructed them to secure the contents of the box, whatever it was, in another box that only they had access to until further order of the court. And so my guess is you're into some kind of order like that. In other words, you're going to get some third party to be able to secure it and be responsible for it, and that way it's not open to everybody. So, any other questions? Yeah, Joy. Up here. It's all right, it'll come to you. It's getting there. It's almost there.
So it's immutable, it's traceable. Why is it so volatile?
It's a really good question.
Because nobody really knows where the value comes from. It's kind of what Sheldon was talking about there in a little video clip. What's behind it? Why is there perceived value? Why does it go up and down? It's a supply and demand thing. If there's more people trying to buy it than sell it, the price goes up, and the reverse is true. But that's the problem, and that's what nobody seems to be able to get their head wrapped around, is where does the value come from? It's that shared myth where, which may be true for some of the big swings in the stock market when stuff runs way up and then falls off. There's winners and there's losers. It's our belief as human beings that something is going to rise in price as opposed to fall. There's nothing backing it.
Right. So it's strictly, in its purest sense, supply and demand. That's it.
Now, my guess, and I don't have anything empirical to support this, but in places, for example, Venezuela that Ed mentioned earlier, that when things are in upheaval and people are scared, they're more likely to go to an asset like that they can easily get out of the country, that they don't have to be tied to it geographically, that has perceived value anywhere they might be.
And that, by the way, is one of the more interesting issues, which is where you get the discussion over how it's maybe used in terrorism or other events. The idea is, if you're in a really volatile situation, it becomes, if I travel on a plane, I'm going to fill out something if I'm carrying more than $10,000 cash or whatever it is. You can move millions of dollars by the stroke of a key in cryptocurrency, and you can move it anywhere in the world. And so that's the concern that you run into when you run into government regulation. That's why you start seeing the government stepping into it, because, right now our government can monitor the movement of most money, most large sums of money. So the concern that they have with, and why you see a crackdown on some level from the federal government about this, is that the movement is really unregulated in terms of being able to take it out of the country or being able to move it. And so that becomes one of the critical areas.
You can bet that the government and the FBI is spending a whole lot more time on this now than they have in the past. It's
no question.
They've recognized the size of the pool. I mean, there's billions of dollars out there right now in cryptos.
Yep. All right, David's bringing you a
Question
mic.
over here. Yeah. Thank you. It seems that the value of this Bitcoin, capital B, is based on the technology that developed this blockchain technology. since technology is developing very rapidly and things that were unimaginable 10 years ago or 20 years ago have become reality, what's to prevent technology in 10 years that renders this technology obsolete or renders it easily hackable, or computing technology becomes so strong that the mining is, you're able to mine a lot faster? I mean, why isn't that a major concern?
It probably is.
Right.
I mean, the answer is there's nothing. For example, we're going to get a little technical on this now. There's something called Bitcoin, and then there's Bitcoin Cash. And they're not the same thing, and you'll see them in separate entries if you get a Bitcoin wallet. Well, what happened, and I'm not sure I can even explain this well, several years ago there was what they called a split in the blockchain. And this new type of currency developed. The blockchain size, the size of data in a block on the original blockchain, on the new blockchain is 8 times that amount. So the technology is evolving. Now, whether that makes the hashing of the data easier or harder, I don't know. I don't know, but it's constantly evolving.
But I think you're right. In other words, technology is going, now separate two different issues. The technology is developing, and that's really when you get into your blockchain issues and all that, and who knows what the next big thing will be. Blockchain serves some real purposes, mostly because of its decentralization and its immutability and things like that. As to the value that is, that's the value of that technology. That has nothing to do with the value of an individual cryptocurrency. It's really the difference between the platform and the platform that the cryptocurrency is simply traded on is what it is. So, but I think you're right. There's, who knows what the next big thing is. But this right now serves a definite need, and I think we both can suspect that over the next 10 or 20 years, we're going to see blockchain becoming a significant part of what we do.
I know one of the sections that's coming up, I think tomorrow, is on vice-based industries, like, I guess, marijuana or gambling or prostitution.
Welcome to Vegas.
I think it was one of the rappers who backed a GoFundMe kind of thing with cryptocurrencies, weed coin or something like that, for the specific purpose of buying legalized marijuana. So, we're going to see it touch every industry that's out there.
Not that we ever would, but how do we accept Bitcoin for our fees?
Well, it's interesting you'd ask that. I wanted to, and so I got online and I tried to sign up so that I could put the little Bitcoin emblem on my website and say I accept Bitcoin. And the response I got back is, we're not currently accepting new vendors. Please check back.
So you have to be accepted as a vendor to be able to accept Bitcoin.
Dave, it's no different than if the process you went through when you decided to apply to accept credit cards at your firm.
Well, that's what I'm saying. They didn't reject us. They
well, in this
all
case,
the vendors we wanted.
I think they weren't prepared for the expansion. Is really
I
what Richard was talking about.
I think that's what happened. Now, personally, if a client came to me and said, I'd like to pay you in Bitcoin, I said, my business isn't set up to accept Bitcoin, but I have my own Bitcoin wallet. Could I have him transfer it to me directly? And then you got the ethical question about, do you share it with your partners? But
Can organizations have a Bitcoin wallet?
They can.
Or they're only personal?
They can, but I think it goes back to that Florida, the DCA opinion that talks about the idea that to the extent you have a wallet, it's simply got to be for an immediate conversion. In other words, I don't think it's reasonable if you have money in trust to have volatile money in trust. And so, because you're responsible for safekeeping the client's property. So if a client gives you $25,000 and says you're responsible for safekeeping, and 3 months later he says, okay, I'm done, I'd like my $25,000 back, and you have, well, I've got 5 here. And so that's why I think it has to be converted immediately if you're going to go down that road.
But if it's your own money, if it's earned, it's earned. It's yours. You do with it what you want.
I mean, it's just a matter of whether it's trust or not. And I mean, I can tell you I'm more on the conservative side. I probably wouldn't deal with it. It's too much of a hassle. And if the guy has Bitcoin, he can convert it to cash and transfer it.
Any other questions you have?
There's somebody back there.
Maybe I missed it when you had the charts up about centralization and decentralization, but I saw the decentralization that's Bitcoin. Who's in charge? How is it financed? Who was the one that said, we don't take any new vendors?
Well, that was the, I think it was Coinbase I contacted in California. They're just an exchange. The actual distributed ledger belongs to everybody. All the code is open source code. The hash is open source. Everybody uses that same SHA 256 hash. So the answer is everybody owns it. It's the ultimate democracy. The government is completely out of your life. They have nothing to do with it. You're not relying on banks, insurance companies, Wall Street. It's peer-to-peer. It's a pure peer-to-peer type network.
And so it's just one vendor that's telling you they're not doing business at that point. There are lots of vendors out there if you really wanted to go the distance to do it, but there are different interfaces.
One more question.
Okay.
Your materials indicated there was a limit to Bitcoin in terms of
21 million Bitcoins.
How was that determined? And
It's mathematical. Right. It has to do with the algorithm that Satoshi Nakamoto came up with to do it. My math is not strong enough to even begin to understand what's behind that. But again, understand that while there's a limit of 21 million, it's almost infinitely divisible into smaller units. I think a Satoshi is 1/1,000,000th of a Bitcoin. I'm not sure if I'm right about that.
Our value comes, to a large degree, value comes from the fact that we can't just continue to expand and add more Bitcoins over time.
Are Bitcoins always converted to dollars?
No, you can convert them to yen, euros, whatever.
So it's 21 million Bitcoins. It could be
No, they're talking
17
about-
zillion yen and
It's
whatever.
21 million Bitcoin units and subdivisions of each particular Bitcoin.
I
And
think
that's the limit in
something
that
I read
platform.
said that the last will be mined in like 2030.
One last question, then we're going to go to a break.
Understand. First of all, I want to acknowledge the two of you for tackling a subject which is incredibly deep and complex. This may be the first time in my 23 years in business that people maybe would have preferred hearing about marketing rather than what you talked about because it's so complex. Secondly, we have if you go to FamilyLawyerMagazine.com, to give my own magazine a plug, there's a few articles on FamilyLawyerMagazine.com about this from 3 different family lawyers, and we're always looking for more information. But you can find some there that will perhaps help this very complex subject, how you apply it to your own practice.
Yeah, we just tried to give you the buzzwords. Look at the glossary in there. If you have more interest, there's so much available online. You just kind of got to pick your own level of comfort. That's why that Udemy, I think, is very good because they have different level classes. They break them up into small 2- and 3-minute videos, so you can you pick it up as you feel like, put it back down again.
Right. The goal is recognize the red flags. Don't be intimidated. Have a basic vocabulary so that when you see this, you know when to reach out, how to avoid some common pitfalls, and be just a step ahead in knowing when you need some help.
Thanks, guys.
Thank you for indulging.
Word break.
Thank you so much. Thank you very much.